The first atomic bomb was dropped on Hiroshima.
Over humanity!
The fires of frustration and discord are burning in every
Let us
city.
not forget for a moment the toils and efforts that lie ahead.
They say that those who forget their history are condemned to repeat it. This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey, author of History Lessons for the Modern Investor, and your guide to financial wisdom in the past, present, and future. You ready? Good. Let's get historical.
Hey, I'm Patrick Huey, author of History Lessons for the Modern Investor, and this is how history can help inform your investments, retirement, and tax planning for the week of December 15th, 2025. And today we're focusing on taxes, everyone's favorite subject, particularly at the holidays. But on December 16th, 1773, it was the Boston Tea Party that turned a tax dispute into a global revolution. On the evening of December 16th, 1773, a group of colonists in Boston Harbor quietly boarded 3 British ships, the Dartmouth, the Eleanor, and the Beaver, and they went to work. Disguised, poorly I might add, as Mohawk Indians, they split open hundreds of chests and dumped more than 90,000 pounds of East India Company tea into the cold harbor. Incidentally, anybody who's watched a football game in the Northeast recently knows that it is extremely cold this time of year in Boston Harbor. Their protest was aimed squarely at taxation without representation, a system where decisions about their money and future were made far away by people whose interests were not always their own. For those of us who don't live inside the DC Beltway, that may feel somewhat familiar. Parliament responded with the Intolerable Acts, doubling down on control, but the damage was done. What began as a fight over a tax on tea helped ignite a broader revolution about who should hold power, who should benefit, and how much control distant authorities should have over individuals' lives and livelihoods. For modern investors, the Boston Tea Party is more than a patriotic story. It's a reminder that if you don't pay attention to the rules and who writes them, your wealth can easily be managed for someone else's benefit instead of your own. Here then are 4 lessons for the modern investor from the Boston Tea Party. First, know who's really in control of your money. In 1773, the colonists' core complaint wasn't just the price of tea. It was that decisions about their economic life were made by people who didn't speak for them. Many investors drift into a similar situation today. Oversized positions in a single company stock because that's what my employer offers, or default target date funds they don't understand, or high-cost products sold more for a broker's commission than a client's benefit. Retirement planning starts with representation, making intentional choices about where your savings go, how they're invested, and who gets paid along the way. If you can't explain who benefits from your current setup, it might be time to dump the tea and reclaim some control. Second, taxes are inevitable, but waste is optional. The Tea Act, when it was introduced, was framed as making tea cheaper, but its structure helped a favored company, the East India Company, and still left colonists with no say over the tax itself. Now, today's tax code is complicated, even more so after July's revisions, but individual investors often react by ignoring it entirely, paying more than necessary in avoidable taxes. You can't escape taxation, but you can avoid waste. Using tax-advantaged accounts, placing tax-inefficient assets in sheltered accounts, being thoughtful about capital gains timing, and harvesting losses when appropriate. Like the colonists, you don't have to accept every structure at face value. You can choose how to participate. Number 3, beware of hidden taxes in your portfolio. For Boston's merchants and consumers, the offending tax showed up in the price of tea. For modern investors, many taxes are hidden. High expense ratios, sales loads, frequent trading that triggers short-term gains, and products with opaque fees. Over decades, these costs quietly confiscate a portion of your future lifestyle. A key retirement planning skill is reading the fine print, understanding fund costs, trading behavior, and how advisor or platform fees will compound. Before you react to market volatility, it's often smarter to throw the overpriced tea, i.e. needlessly expensive products, overboard first. Finally, don't let emotion drive destructive rebellion. The Boston Tea Party was dramatic, but it was also targeted. Remember, they destroyed tea, not people. They made a point about governance.
You suck.
In investing, your emotional tea parties happen when fear or anger leads to scattering your holdings, selling everything in a panic, or making wholesale changes without a plan. That kind of rebellion usually punishes you more than any distant authority. A more productive version is financial civil disobedience, quietly and systematically redirecting your savings into low-cost, tax-efficient, diversified structures that serve your goals. You don't have to burn the system down. You just have to stop playing the most rigged games. Here's a final thought. The Boston Tea Party was about more than tea. It was a statement about who should have a say in how value is created, shared, and taxed. As an individual investor, you are not a passive subject of someone else's financial empire. You have tools the colonists could only dream of: transparent information, low-cost investment options, diversified global markets, and legal ways to be far more tax efficient. The question is whether you will use them or let someone else keep writing the rules while you quietly pay the bill.